Imagine reaching your mid-40s and wondering if your financial progress is on track compared to your peers. In 2026, the economic landscape is shifting rapidly, and understanding where you stand financially can either be a wake-up call or a massive confidence boost. Today, we are going to uncover exactly how much the average 45-year-old in the United States has in their retirement accounts, savings, and overall net worth, and more importantly, how you can measure up and optimize your own wealth-building strategy. Whether you are just starting to take your finances seriously, looking to accelerate your investments, or aiming to refine an already robust portfolio, this video will break down the essential numbers, actionable benchmarks, and the exact steps you need to take to secure your financial future. Stick with me as we dive into the data, explore practical wealth-building tips, and find out if you are on the right path to financial freedom. Part 1. The average retirement account balance in 2026. Understanding where your retirement savings stand at age 45 requires looking at the current financial landscape of 2026. Across various retirement accounts, such as employer-sponsored plans and individual accounts, the average balance for individuals aged 45 to 54 currently stands at roughly $313,000, according to recent data from the Federal Reserve and financial institutions. However, relying purely on the average number can be misleading because a small percentage of individuals with exceptionally large accounts significantly skews the data upward. A more realistic baseline for the typical saver in this age group is the median balance, which is significantly lower at around $115,000 across all accounts, and roughly $67,000 specifically in typical workplace plans. This significant difference between the average and the median highlights the reality that while some people are well prepared for the future, a large portion of the population is still falling behind the recommended savings benchmarks. Breaking down these numbers by income level and financial experience offers a clearer picture for both beginners and advanced investors. Financial experts typically recommend that an individual should have about 3 times their current annual salary saved in their retirement accounts by the time they reach age 45. For someone earning a middle-class income of $80,000 per year, this means a target balance of $240,000 would put them on track to retire comfortably, whereas advanced investors might aim for 4 or even 5 times their salary to ensure early retirement or a higher standard of living. Beginners often find themselves far below these recommended benchmarks, frequently holding closer to the median balance because they started saving later in their careers or have prioritized short-term debt and immediate living expenses. For these beginners, the focus should not be on comparing themselves to the average, but on increasing their savings rate steadily, starting with taking full advantage of any employer-matched contributions, which essentially acts as free money that doubles the impact of their personal savings efforts. For those at an intermediate or advanced stage, the focus shifts toward optimizing the composition of these retirement accounts and leveraging the power of compound interest. By the mid-40s, individuals who have been investing consistently for 2 decades can harness exponential growth, meaning that market returns begin to outpace the actual cash contributions made from their paychecks. Advanced savers often utilize a mix of traditional and Roth accounts to diversify their tax liabilities for the future, while also making additional catch-up contributions allowed by the regulations for savers aged 50 and older, preparing themselves for that next phase. Achieving and exceeding these balances requires taking a close look at the fees charged within your investment funds, as even a minor difference in expense ratios can reduce your total balance by tens of thousands of dollars over a 2-decade period. Taking the step to review your current portfolio allocation ensures that your hard-earned money is working efficiently to close the gap between your current balance and where you need to be by the time you choose to exit the workforce. Part 2. average net worth, and liquid savings. When evaluating your overall financial standing at age 45, you must look beyond retirement accounts and examine your total net worth and liquid savings. The data for 2026 shows a stark difference between the average net worth and the median net worth for households in the 45 to 54 age group, with the average net worth hovering around $975,000, while the median net worth is much lower at about $247,000. This massive gap occurs because the average figures are skewed heavily by the top tier of wealthy households and the accumulation of high-value real estate. For a beginner to intermediate investor, focusing on the median net worth provides a far more accurate reflection of where the typical American family stands in the middle of their career, especially once you remove primary home equity to look at liquid assets and investment portfolios alone. Liquid savings and accessible investment funds serve as your financial safety net and are crucial for handling emergencies or unexpected life changes before retirement. Financial professionals generally recommend keeping between 3 to 6 months of essential living expenses in a highly liquid, high-yield savings account or money market fund. For a 45-year-old, this typically means having an emergency fund ranging from $15,000 to $30,000, depending on your monthly obligations and household size. Beyond emergency reserves, intermediate and advanced investors usually hold additional liquid capital in brokerage accounts or short-term treasury bills. These accessible funds allow individuals to capitalize on sudden market corrections, invest in new business opportunities, or cover significant out-of-pocket expenses without being forced to tap into long-term, tax-advantaged retirement accounts and face early withdrawal penalties. To build an accurate picture of your net worth statement, you need to tally all your tangible assets and subtract your liabilities, such as credit card debt, auto loans, and mortgages. Your assets should include the current market value of your home, your vehicle's business equity, and any non-retirement investment accounts, such as individual brokerage portfolios or cash value life insurance. Beginners often make the mistake of including the full equity of their primary residence as liquid wealth, but this is a fixed asset that cannot be spent easily without selling the house or taking out a home equity line of credit. Understanding the distinction between a liquid wealth, such as real estate equity, and liquid net worth helps you maintain a balanced financial profile, ensuring that you have both long-term asset growth and immediate financial flexibility in case of economic shifts. Part 3. The wealth gap between beginners and advanced savers. The wealth gap between beginners and advanced savers at the age of 45 is vast and primarily driven by how early an individual started investing consistently and the types of assets they hold. Beginners in their mid-40s often find themselves lagging behind because they treated savings as an afterthought, prioritizing immediate consumption over long-term wealth generation. On the other hand, advanced savers have utilized the power of compounding by allocating capital to a diversified mix of equities, real estate, and index funds continuously for 2 decades. This difference in approach means that while a beginner might have a net worth of less than $100,000, an advanced saver could easily have a net worth exceeding $1 million by the same age, purely because their money has been working for them much longer. Understanding this divide allows you to see the true cost of delaying your investment journey and highlights the urgency of making up for lost time by adopting more aggressive savings habits. Bridging this wealth gap requires an honest assessment of your current financial habits and an adjustment to your cash flow management. If you are starting late, you cannot afford to rely solely on standard savings accounts that offer minimal interest and fail to beat the rate of inflation. Beginners need to transition into intermediate practices by opening brokerage accounts, educating themselves on the benefits of low-cost index funds, and automating their monthly investments so that saving happens before they have the chance to spend their income. Advanced savers understand that wealth is not just about what you save, but also about protecting that capital from unnecessary taxes and inflation. They make it a priority to maximize contributions to all available tax-advantaged accounts while keeping their fixed living expenses low, which creates a large surplus of cash each month that can be reinvested into income-producing assets. The psychological aspect of this wealth gap is just as important as the mathematical one, as it dictates how individuals react to market fluctuations and personal financial setbacks. Beginners frequently make the mistake of reacting emotionally to market downturns, selling their investments at a loss out of fear, or succumbing to lifestyle inflation as their income grows, buying larger homes and more expensive cars rather than acquiring more assets. Advanced savers, by contrast, view market volatility as an opportunity to purchase quality assets at a discount and deliberately avoid lifestyle creep to keep their savings rate exceptionally high. To close the gap at 45, you must adopt this mindset shift by treating your investments as fixed, non-negotiable monthly expenses and continually seeking ways to increase your earning power to feed your investment engine. Part 4. Common financial mistakes to avoid at 45. Reaching your mid-40s usually means you are entering your highest earning years, but this comes with the temptation of allowing lifestyle inflation to outpace your savings. A major misstep at this age is lifestyle creep, where people use salary increases to finance bigger homes or luxury cars, rather than routing that extra cash into investments. While it is completely fine to enjoy the fruits of your labor, letting discretionary spending absorb all of your raises severely damages your ability to build a robust net worth. To correct this, you can implement a straightforward rule where you dedicate half of any pay raise to increasing your retirement and investment contributions, ensuring that your savings rate rises alongside your income without feeling deprived. Another critical mistake is failing to tackle high-interest consumer debt or using home equity to finance short-term lifestyle upgrades. Credit card debt carries interest rates that easily destroy the gains you might make in the stock market, acting as a constant drain on your monthly cash flow. Similarly, treating your mortgage or home equity line of credit like an ATM to pay for vacations or non-essential purchases reduces your foundational wealth and limits the compounding potential of your capital. Advanced savers understand that debt elimination must be treated with the same urgency as investing, because becoming consumer debt-free frees up significant amounts of cash that can be redirected toward wealth-building assets. Finally, many individuals become far too conservative with their investment portfolios as they approach their 50s, which is a mistake that slows down long-term growth. Because you still have 2 decades before reaching traditional retirement age, your portfolio needs to maintain exposure to equities and index funds to outpace inflation and compound effectively. Shifting too heavily into cash or fixed income assets prematurely can cause your nest egg to lose purchasing power, leaving you short of the recommended 3 times salary benchmark. Taking a balanced approach means adjusting your risk tolerance gradually rather than pulling out of the market entirely, preserving the long-term engine required to secure your financial future. Part 5. Actionable strategies to accelerate your wealth. Accelerating your wealth creation at age 45 requires a deliberate shift in how you handle your income and where you direct your surplus capital. For beginners, the most actionable first step is to establish an automated transfer system that moves money from your checking account into an investment or high-yield savings account the very day your paycheck arrives. This technique eliminates the temptation to spend the money on non-essential items and ensures that your savings goals are met before you pay your regular monthly bills. By starting with a small but consistent percentage, such as 10% of your gross income, and increasing it by 1% every few months, you build a sustainable habit that gradually prepares you for more advanced financial maneuvers without causing a sudden shock to your daily lifestyle. Intermediate savers can accelerate their trajectory by maximizing their contributions to tax-advantaged accounts and focusing on broad market index funds that track the major economic indices. When you are in your mid-40s, it is essential to take full advantage of both employer-sponsored retirement plans and individual retirement accounts to minimize the drag of taxes on your investment growth. You should aim to capture the full employer match, as leaving this money on the table is one of the most common and damaging mistakes people make. Furthermore, keeping your investment portfolio simple and low-cost allows you to retain more of your earnings, avoiding the high management fees that eat into your total returns over the long term. Advanced strategies for individuals in this age bracket involve utilizing catch-up contributions and diversifying into income-generating assets such as real estate investment trusts or dividend-paying portfolios. The regulations allow individuals aged 50 and older to make additional contributions to their retirement accounts, but preparing the cash flow to handle these larger contributions should begin at age 45. You should also conduct an annual financial audit to identify recurring expenses or unused subscriptions that can be eliminated, freeing up hundreds of dollars per month to put directly into the market. By taking these steps to optimize your accounts, lower your investment fees, and increase your monthly contributions, you ensure that your wealth compounds at an accelerated rate for the rest of your working years. Understanding where you stand compared to the average 45-year-old in 2026 is a powerful step toward taking control of your financial destiny. Whether your net worth is just beginning to grow or you are well on your way to a comfortable retirement, remember that your personal finance journey is not a race against others, but a continuous path of improvement where every small contribution and intentional decision compounds over time. If you found this breakdown helpful and want to continue learning how to grow your wealth and secure your future, make sure to subscribe to the channel and hit the notification bell so you never miss an update. I would love to hear your thoughts on today's numbers, so please leave a comment below with your favorite takeaway or a phrase that resonated with you, and I will see you in the next video.